All right, guys, we're going to get into the technical aspects of future spreads, and that involves swing trading future spreads. Now, most professionals, institutes, banks, everybody, we swing trade these things. It's hard to find intraday strategies unless we have algorithmic robots and stuff like that. And by the way, I'm working on that currently. We've already tested a couple of days in our Facebook Live group, which by the time you watch this will probably be transformed into the Discord group. But we tested intraday trading crude oil spreads. Now there's a bigger cost on the commissions because you're trading two contracts each way. So I think we kind of nailed something down. If you don't see a video in the technical trading section for intraday future spread strategies, it will be coming around. Just depends on the time that you watch this version of this video series. But I'm working on something. I just have to put a little bit more of a nail in the coffin on it, to make sure that when we're doing them during the daytime, we're doing them on a commodity such as crude oil that could move big enough for us to make up and offset our commissions. So that it looks like, we have several hours of live video that we did on it, and it worked. I just don't know how good I feel about putting it yet as a part of a curriculum. Again, because it's something that more machines do. It's algorithmic kind of style of trading. And by the way, our programs that we have, our desktops we have with our brokers, they can, they have the technology to do it, but you got to hire people and write code and stuff. So for the meantime, we're going to get into our traditional way of technical trading, which is using swing trade future spreads. Doing future spreads with using technical analysis and high time frames. So some of the tools and indicators, look, over the course of your career in trading, and even mine, things change. But some of the number one things that stuck with me is what I'm going to use here because they're a base. And then later on, you can always add things depending on time frames you use. Like I mentioned in a prior video, day traders will use different things like volume profiles and opening range breakouts and stuff like that. So depending on what you're doing, it is indicative of what you use, right? So I tend to use a lot of support resistance in high time frames. Time frame is very important for the support resistance. And what is that for the new people? Support, let's just picture, is a floor. It's a base of where price hits and gets tested and supports a lot more than one time, 2, 3, 4 times. It's multiple support. You hear the words people call double bottoms, triple bottoms. Before sometime they'll break through. They don't always hold, right? They're called breakouts. But that's a support, and resistance would be a ceiling. You jump up in your room, if you're tall enough, your head hits the ceiling, you just got hit by some resistance, which was the ceiling. And so price, a lot of times in high macro time frames in commodities and even in Forex, happens to respect support resistance areas. And so this is where we use as a base to find high probability trading opportunities. And so monthlies, I have a little cross out on it, guys. I respect the fact of everything I learned from my mentor, but when we're swing trading these things, looking for shorter, quick turn, quick possibilities, the highest I'll probably start from is on my dual chart is start looking from weekly dailies on something. If something is looking a little bit appealing, or whether it is or not, I'll still hop down into like 4 and 2 hour time frames. I'll do this because shorter swing term, maybe, within a week or 2 time span, I might find something. Again, I'm not looking at a seasonal opportunity. I'm not looking for the 4 time a year event on a trade. I'm looking at a high volume commodity on the spread level that has high volume in the spread. And so that way I can get in and I can swing trade and maybe make 10-20% of the regular outright move in a shorter time frame, so I can keep rinse and repeating and recycling the cash flow. And it's at that point, it's cash flow coming from the markets, cash flow you took from somebody else. Moving averages, it's fine line. Some people love them, some people hate them. In shorter time frames, a lot of things don't work as good as higher. In higher time frames, I found that using 50 and 100 exponential moving averages work pretty good. And the way that kind of works is exponential and simple moving average. I don't know much to get into that. I don't care to. But 50 or 100 or the time frame, the number 21 that you hear about people using, and 10 is just scaling, is just taking the average of that amount of days or hours or weeks that you have on that chart. If I'm looking at a daily and I have a 100 EMA on, it's printing me out a line of the 100 daily moving average. If I turn it on to 50 moving average and still keep a daily. It's just 50 daily moving averages, and then the price is following along that. That's actually following the price, but you'll see that in higher time frames, they're pretty good and reflective of a possible bull run or a bear situation, a bullish or bearish situation, short or long, because other participants that are in technical trading tend to make things, when a lot of people are doing something, it works for a reason, because a lot of people are watching things. So I use Stochastic. This has been something that I try to drop sometime, and it always will come back to me. My original mentor taught me technical trading a long time ago on bonds, and still till today we talk about he never deletes the fact of using a stochastic indicator. But the setting that I've been using is same as his. I put my K setting as a 5, and I make my D line as a transparent line. Does it sound confusing to beginners? Don't worry about it. I'll show you on a chart, like I did in the setup. That part was in the setup. Stochastic lines, they're like they converge and diverge two lines with each other, and they're usually at the bottom of your screen. And we tend to just use the K line and make that second line transparent, so it's not on the screen, and I'm using it in kind of like moving faster. I'm using it to catch divergences in price. Okay, so it's kind of a momentum shift. I'm trying to catch when price dies to one direction, especially in double bottom, double top situations and things like that, to catch a turn, or a higher high that has a weaker stochastic moving up along with it is showing me divergences, and this helps a lot, especially in higher time frame, guys. I've tried it in short time frames. It's really hard, especially because the stochastic can move and pop real quick too. So when you're doing it live, it's a different beast. When we're swing trading it, higher probability. Okay, so we're gonna go on ahead and get into our charts, ladies and gentlemen, and then we'll go from there. And my chart starts with an alert. I kept it there. Intraday, I'm doing some strategies with a good friend of mine, the day trader, and we're not doing usually the cash U.S. session market. I notice micro NQ, micro ES, very whippy. I found a lot more transparent price action on it during Asian and London session, mostly London. So it's middle of the night stuff. I'm gonna go ahead and just turn off and pause these alerts. And if you look ahead at the dual screen ahead of me, I'm starting with the crude oil. Now, a lot of things we have during this video series, we have COVID-19 and a lot of other drama going on with of course, the Saudis and OPEC on this oil deal. This is all happening at the same time. So a lot of charts currently now have had some significant drops. And when we start with our weekly and our daily, one thing that I'm using, guys, the tool that I told you to get in the setups, the support resistance that's dynamic, that draws it for you, it's having trouble drawing on higher time frames, because again, the gentleman who wrote it for just slightly smaller time frame, the 4 hours, 2 hours, 1 hours, and so on. So, and the guy's generally trading currencies, Bitcoin, things like that. So you got to use a little bit, especially because of the way the prices had some action here. Just got to use a little bit of good judgment. So, obviously looking on a weekly chart where every single candle is a week, it's had a big blow the first week of March, along with everything else. And people thought, oh, this is probably tied to COVID. This was some drama going on with crude oil. Anyway, out there in the Middle East and the Russians and them. So we're not going to get into that. Let's just talk about what really kind of went on here. Price hit a support area. We saw a strong week, pull back halfway into that. And so really, I mean, when things get so low, $20 a gallon, and we know we have a president that's getting involved now, all I'm concerned about looking at price, if I double click and I got my stochastic here, is that it's slowly sliding back up. And we've been seeing that. And we've been getting really good opportunities long on crude. Price action wise, it's not much to show off and talk about here on these, but I just want you guys to be aware that sometimes it's going to look like this. And just kind of, because things have been a mess lately. So I'm showing it probably to you at the worst possible time. And here's a daily chart. And pretty much, again, if I have to look at EMAs, obviously, since the time, if we use it this way, oops, let's go back to the daily. As of the time it broke down, if you were using EMAs to say, okay, I'll take shorts on every time it does that, and I'll go long, you would have been in a nice short position, and you would have had the luck of the gap down. you would have been up a lot of money. Okay, and crude oil can do that because it has a lot more noise than other things. But it's not as bad as like cattle and hog, which, by the way, in this curriculum I've turned off because I don't want you guys to learn it. I've been sim trading some things. As you see, it's very profitable. There's hog right there. I was testing all this technical stuff. So these were all trades that I did on swing trades, and they took about a week. I'll get into that at the end. But see, as you back up, normally when the hype and the noise is not really around, crude oil is a really good thing to trade. Look how we had ranges here. And we can tell things are in range when they're bouncing in between these support and resistance areas. Okay, and also the EMA is smack in the middle. You can clearly tell this is a range. And most people, some people don't like trading this. Directional traders will be like waiting for a trend to pop, seeing price strongly, EMAs, moving averages really pointing to the downslope or upslope, and they'll know that there's good short opportunities to trade pullbacks. Like here where we had this EMA and we had price just bouncing off of it, So if you felt like you missed an opportunity, like we did in our nat gas commentary yesterday, April 12th, you could see that anytime there was a pullback, there was an opportunity to go ahead and go long, and just and so on. So our support resistance lines that are dynamic don't draw back as far as possible, but there's so much advantage having them automated and dynamic that you can make decisions quick at the fly. And so that's what we're using for that. When we're looking at divergences in stochastic, let me talk about that real quick. When price hits newer highs, and this is what it means. Let me pull up this, guys. This is the coolest thing about divergence and how it seems to work all the time, almost all the time. See if I can do that again with that. Do another one. See, you have to look smack down at the price in stochastic, exactly where it is. And you see that price is making newer highs. It hits resistance areas. So there's another good key. It hit a prior high of about 65.60. It comes up with a lot of momentum that day. This is on a daily chart, so each candle is daily, and it comes up hard, but the momentum behind it was weak. What does that mean? It means that buyers were getting exhausted there, and we could have caught a signal here and say, this is a good opportunity. At the end of the day, you could have maybe seen it. Okay, close the day. If some people theorize that stochastics bump and pop, they do on short time frames a lot. Here's what divergence short, because the stochastic indicator is weaker than the price. It's a perfect divergence short. In the next series of days in the week, it did nothing. And then it popped down. I mean, if you were short ahead of time here, this is how you caught your signal. Okay? How could we catch them on longer sides? The dynamic line doesn't draw as perfectly all the time, but you can also become a little bit of a pro yourself, make a horizontal line here where you see price hitting a lot of times. Now you have a new floor, right? You built a support. You see price hit here, went up, came down, and is bouncing up where the moving average is also becoming almost like a resistance. The resistance dynamic line is becoming resistance, so you can see a nice range. And when price came down maybe here, in these areas here, these bottoms, which it's done it once, 2 times, 3 times, you now look at your stochastic and you see that it's pointing upwards and has been doing this for 1, 2, 3, 4, 5, 6 days. Now you could have been like, man, okay, maybe I'll take a stab at this. There's a chance that, this range is real tight, but I want to make sure I get a good move out of it. Will I be able to do it? Don't forget that you're on a daily time frame. In a daily time frame, guys, the range on this thing is not as bad as it looks. It's a $7 move over several weeks of time. So, a $7 move in crude oil is equivalent to about $7,000. Oh, and just real quick, for the super beginners or even the pros that want a good reference tool, because I know that the CME and blah, 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 and your current broker may have just really, sorry to use the words, crappy charts on how much is a tick size and what's the increment. I found this company, ampfutures.com. They're very generous enough to make these contract specs very nice, clean, legible. And so you can go in here and check out all the different products, the micros, how they move, what months they trade at. Most of them trade January, March, June, whatever, HMUZ, December. And You have all your different stock indexes, your energy. So if you come here to energy, you can see WTI light sweet crude. Crude oil, CL. You trade what it trades at, and every penny is $10, right? So every penny is $10. So here, just reference this, guys. Find that at ampfutures.com and put it in your favorites or print it. It's a really nice sheet, especially if you're new or not even new and want to reference to like, okay, hold on, we're talking about corn now. What months do they trade? They trade in quarter increments, and it's $12.50 a tick. So every time that your price moves a tick on that chart, on this chart, these little ticks, that's considered the value of the tick. And what is the value is equivalent to what it says there. So when we're dealing with crude oil, let's go back down over there. Where is it? Where'd it go? Crude oil, CL, okay? It's trading at 1 penny increment and it's $10 a penny, the outright, okay? So your spread will do the same thing. You just, as you know, and you've learned by now, you get a smaller percentage of the actual move. So this was a $7 move, guys, over several weeks. It's not a bad move. It's ranging, but it's ranging enough for you to come in here, put on a trade. And a $7,000 range, you know, if you did a really conservative spread trade, then, you know, you could get anywhere from 10, 20, 30% of that move. And how do we do that? How did we put on that spread? You've seen this a little bit already, right? I've shown you guys in the setups how to save your charts. Showed you guys how to build all this workspace and given you links where TradeStation helps you with that too and things like that, right? Okay, so if we click here on our crude order that on our market grid, on our crude calendars that we already have. And why am I holding a short position here? Am I still holding that short position there? It looks like, yeah, my net positions are gone. Looks like, do I have a pending order sitting somewhere up in there? No. It says I do. It's weird. A simulation is sometimes weird when you do it between your phone and just a simulation, guys, because I've been doing things out of my bed. All right, well, whatever. So let's say we were going to trade this back at that time, whatever. We wanted a long position, but then you're just going to find your calendar spread, and we've talked about the differences in months, right? How volatile they can be, how they pay out more the more you spread your months out versus the safer conservative is month to month. So you would just come on in there and put on a trade. You know, you wanted to buy it, right? So you could put in a resting order here to buy it. As you see, it's moving quick, so you got to be quick too. So you put in one. This one is saying that I'm short one here off of the sim, so I'm just going to go and do a market order to close it. And now it's my net positions is 0. And that probably skewed this. That's odd. I don't know. Anyway, whatever. It doesn't matter right now, guys. We're just in the instruction. So, you know, once you determine what spread you want, you come in here. Okay, I want to take long. What's the spread that I want to take? It's going to be based on my risk tolerance. Oh, I'll take May, June because it's going to give me a good enough move, 10, 20%. I'm not willing to, with my account size or whatever, or etc., lose or win as much more. So most guys that are a little bit more aggressive tend to go with 6 months out and stuff like that. You can get about 50% of that move on that daily move, whatever it's doing lifetime. That's what you get on your spread. I remember this thing when we called this thing short back in January. We had a commentary on that too, and we even made a YouTube video and everything, and it just sank. And we never knew that it would do this. I never even knew. I was in some trades where I pulled out of here and took my profits. I thought I was a king because I sold in here at the top and I covered at the bottom, and I felt like really great. But then I did all that, and that's part of the markets. You just, nobody knows. So we're using the stochastic for that. We're using, you know, we were looking at our support resistances, and here's a moving average, right? The few things that I've gone through with you on that, and we haven't even left under the daily time frames yet. So the next thing I'd like to do is usually I'll come in here and I'll change my right screen down to like a 4-hour, and then I can break it down on the left side and make it like a 2-hour. Okay, I just start scaling down a little bit more, and just looking at different things because maybe I want to take short opportunity. Okay, so this will be part of the intraday possible trades as we get into smaller time frame. Again, with a spread, you got to make enough move to cover your commissions. Okay, that's why it's a little bit harder to do intraday with spreads. There's more of a swing trader method. Okay. And to unlock your screen, if you left click and move it up and down, guys, it does that. Sometimes it's very annoying. This automatic button down here, just undo that so you can freely move it. Okay. So looking at, a 2-hour time frame and looking at, a 4-hour time frame, what do we see? We see a lot of opportunities. Okay, it just depends. You have to have the eye for it and start just getting used to seeing things. You see divergence short here at the top. You see sliding divergence short here at the top. What was our range on a 2-hour? Easily just kind of looking here at the price axis, $28, $24, $4, ranges and stuff like that. You want to just play the EMA still, when this thing gapped down and maybe pulled back around here, pulled back here to this support area, in resistance area, you could have went short. Bounced down, hit these bottoms here at $20 last week. We were taking these trades long. We have Facebook Live videos where we did crude oil intraday spread around here. This big candle was a Trump tweet. And I looked like a king in that video too because I was up here somewhere and we killed it on a calendar spread. So this is how you're doing, and we're just talking about one market right now. This is how you swing trade commodities. I would pick just the high volume ones, like we've gone through. Version 1, we had every darn commodity in here: lumber, orange juice. It was ridiculous. These are the main 6 that you want to mess with. Now, euro dollar. Hold off a little bit at this time of this video until you start seeing me talk more about it. It's something I'm working on, and it's the highest trade future commodity interest rate in the world. It's the shortest term interest rate. Okay, it goes in the U.S. financials list, really. 2-year, 5-year, 10-year, 30s, the ultra 30s, and GE. Let's move it to the top here. It's actually the shortest term. It's a 3-month out of the country interest rate. Okay, anytime a dollar is out in different banks and outside banks, international foreign banks are using dollars to do transactions, they're doing it against short-term rates. These are the shortest term rates you can get. But I'm working on the spreads. And so far, I opened one up yesterday, Easter Sunday, and I thought I closed this out for more because until the position officially closes, there's still the P&L rolls on the simulator. So it's $100. I thought I had 175. See, it's still moving, but my position's closed. I had closed it at about $175. Could be wrong. I think it was 125, but see how it's still moving. The overall price on the simulator, even though you close out the contract, it's still moving. No, I'm sorry. My net position is still long here. I'm holding, sorry guys, euro dollar. You see that? Here's my position. So you could go on your spread and see where your any open position is. We're long June and December. So I took a 6-month out spread on this on Easter Sunday, yesterday, 5 p.m. Central, when we opened, and it's up on sim now 87.50. All the other trades are closed out. And this was the biggest move. I know it's an outlier, but we're not doing hog or cattle anymore in version 2. I don't want people playing around with thin spreads. I've done a lot of money in the past with them. I don't want to do them anymore. I don't want to influence other people in them. So that's why they're not even on the right here where I made a new list, liquid commodities. They're not here no more. I've taken them off. They gap a lot. They gap almost every other day. And therefore, not only can you make that kind of money, you can lose it. The reason why I took a long in that simulation was, 1, I was teaching somebody. 2, we hit these bottoms and I knew we were going to pull back up. You just can't get that cheap on hog. This was some fundamental stuff that was freaking people out. And now we got buyers back in. So we gapped up already on a 4-hour. Let's put this on a daily real quick. This is what happened. And I knew seeing this candle, but you see how they just gapped daily. They just limit down. These commodities even limit down. You'll get stuck in them. And so I'm not teaching them anymore. I'm not going to do it. I'm not going to get people involved in markets that'll blow your account out pretty quickly. But for the pro, like guys that are a little bit more seasoned, talk to me about it. We can talk one-on-one about it, because I like to see these kind of profits. You put up a $600 margin and you come up $2,400 on one spread, one contract. This was a test I tried to do on ES, guys. Let's leave equity spreads alone for now. I was doing this because of a test with somebody. We tend to trade deliverable products, physical products, things that are deliverable because there's more cost to carry. There's market structure in them that helps you make money. The difference in price on a price matrix, on a spread matrix, is between May, July, September, all these different wheat months. The difference in their price here, when we talked about contango and backwardated markets and things, is because there's a few different elements that make these prices more expensive in the future. And it's things like storage costs, insurance costs for the producers, and interest to carry those costs. So there's different structure. But when you're dealing with something like the S&P 500 or NASDAQ, it's a different game, guys. If you do ES versus ES, you're if anything, the only thing that's within there is interest, because it's not a physical product, and so things are priced in differently and efficiently. Side note there on for you guys to understand why I said what we're dealing with in earlier videos: soybean, wheat, corn. Let me work on euro dollar a little bit more. It looks like we have a really good opportunity here. Nat gas, crude oil. Okay, this is what we could start with. You could do a ton of, and again, these are one contract trades I talk about. But let's get back to the technical. Let's stick to my point. I'm sorry. Here we go. Let's look at nat gas. Okay, yesterday, Easter Sunday, 2 Sundays ago, I called this breakout. Said, man, we've broken out. We're rallying, and even on seasonality basis, in April, nat gas is rallying up into the summer. What do they use nat gas for? Not just heat, for the powering of all these ACs and stuff like that. Okay, so we lost that. I go, man, I couldn't get in. And we saw the 50% pullback here on the fib and everything right into the EMA on Sunday. And I put this on a commentary and sent it out, and I put it on bar chart. And I said, hey, we have a 50%, Fibonacci retracement, bouncing off of a 50 EMA, looking like a good opportunity here for a buy. And since yesterday, it went up all that way. And as you see, look, it just pulled back down. Something happened out there, some pretty big noise that it made it come all the way back down. But this, as a trade, did, 76 basis points. I don't know how you're calculating this nat gas, guys. But it ran up, and this just happened. Don't know what it is. It's just the nature of the beast of the markets. Hopefully it pulls back and keeps running. Nat gas is getting beat up a little bit out there in the news. Whenever I browsing through stuff and putting my posts, I see commentary from the corner of my eyes on it. But you know what? We're at these bottoms. Let's look at nat gas. Really low bottoms. $1.50. Haven't been down there in a long time. Let's go look at it daily. Break it down from a weekly, which I try not to do anymore. On weeklies, super all-time lows. Just because, like, we announced something, guys, on an entry. I'll talk to you about that in a sec here. You're at these lows, right? You can at a good buy area. You're under this EMA, but you're definitely at an area of double bottoms from years ago. The potential to pull back up, even if it went up to the EMA and sold back off, you still have a good room there to get up past the twos, past the $2 price, and still make good money. And let's go down into the daily. The daily is already bounced up off of there, which you can see why we were probably pulling back down. A lot of traders probably trading off of this. On a daily, we've rallied up 1, 2, 3 days and 3 days of sell-off. So can I see possibly any kind of divergences yet? Still no. Looks like sellers are holding this game last 3 days. But so be on the outlook there for a good pullback. Or a breakout out to the other end. It looks like they're trying to. It's, can't have nat gas cheap forever. And so from the daily, we can look at the 4 hour, and this is where I think we found, on the shorter term, said, hey, we've rallied up, guys. We made it past the 100 EMA on the 4 hour. We've pulled back down. If you did like a Fibonacci retracement here, depending on what you guys want to use, this is what I'm talking about earlier, that you'll end up using other things you guys already probably know. It was like 50% retracement there on that pullback, right off of a 50 EMA. Is like, let's go. I mean, we had what other confirmations did we need? Well, we had it bouncing off that dynamic area of support, the floor. So we had like several reasons, and I posted this on a bar chart and sent out an email like, guys, and it did it, but now something else did. And what it could be is, again, that daily has more power and leverage. Look at the daily chart, guys. So if you're day trading, you might want to if you're swing trading, you might want to only stick with dailies on these commodities where they just make a lot more confluence to these things. Like, look at this range, guys. Like we were talking about earlier, this nat gas, pretty similar price action to crude oil, but it really respects a lot of areas. When we get into Forex bonus, this is why we're going to be doing this. Swing trading Forex, same concepts. The only thing I'm going to add in the bonus there is I'm going to discuss a little bit of pips and all that stuff, but I mean, I'm not no Forex pro. I trade Forex just with this style, this same language. Okay, and some of you guys want to go and dabble at your stocks out there. You can get your best probability, high probability entries and exits with this kind of language, when you do it this way. This is what I do. All right, so let's look down a little bit more here. We're half an hour into this. I'm hoping that technical analysis is being understood by everybody. Dual chart, coming down over here to my, could maybe open up a weekly, put this here on a daily, take a look at them. On a weekly, big ranges, huge ranges on corn, okay? But it makes some sense. Let's open her up, Could we make a move back down to here towards the 310 levels and the prior lows from the last several years? This is going back to 2015. Corn's been in this price range since then. Now, last floods here I got ran over. I was using seasonality and was not using technical. I was all about seasonal and no technical. I put technical like away in the grave. I don't know why I did that. I was guilty for it. And, we hit corn as high as in these sevens. Historically in the past, there was some droughts back then here. I was just getting into trading. But we had that was a drought. And in the Midwest, there was a flood last summer. Flood just killed a lot of farmers. And they were hoping, everybody was up there, speculators wanting the sevens. And we were limiting up here these days. And but if you were just paying attention to the price and what it did, you could have got out early. You could have went in long. You could have known when to get out and took your profits. You could have went back in the other way and shorted here when you started seeing divergence right here. And this is on a weekly, guys. This gave you a lot of time to make up your mind. You had a double top on a weekly with divergence to the short side. You had 1, 2, 3, 4, 5, 6 weeks to try to get back down here to the bottom. Hopefully you weren't too greedy, and you took that. Oh, hindsight, Peter, this stuff is easy in hindsight. I get that. I'm always the advocate of trying to learn how to see charts when they're like this. But look when they're like that. Had you not looked at anything or seen anything else in the future, look to the right, and you see double topping in those weeks like that, you see like a reverse pin bar there, and the sellers buyers try again, and they failed, and sellers come back in a couple weeks later, you see the divergence, the momentum weak at these tops like this, where we've been at, kind of before, relatively before we poked out of them a bit, which is normal. It's a zone. Nothing's perfect. It's a zone. It poked out 20 basis points over where it's been before. Pretty high probability chance that this run is over on a weekly, guys. This is a weekly. Higher time frame has higher strength. Higher time frame has higher strength. Coming back into that daily here, you can look at where that was. Boom, boom, boom. Did try this thing and it failed. It failed 3 times. You got some divergences here. You had a divergence here that failed and a double divergence that just kind of from there didn't even give the best signal. So you had to just take your stab at it. You were doing it up against this EMA. You were going down in these small ranges. So, that was expected. Could have maybe taken that other stab at it. And that's the thing too. People, I noticed, and I was guilty for this a long time. I wouldn't be systematic about stuff. People will lose this trade over here and they'll just forget about the whole commodity and move on and go into some other stuff, and they never come back here. They'll just say corn screwed them over. I've been screwed over here bad, right here. I even had a friend that's in a brokerage house in Chicago that sent me a chart like this right here. I was long here and it pulled back. I saw this support. I said, I'm sorry. I was shorting into seasonality. It went up against me, came back down. I thought I was king here. I wasn't looking at technicals. Something happened in my mind where I personally just let it go for a while. It was going off this whole seasonality mentality. And then this candle happened before this. And I got a letter directly from a guy that was watching over my account up in a boutique firm in Chicago. And he said, Peter, look, this just came in onto my desk. I ignored him. I got out like around here, and he got to monitor that account. Then it did that. And then I moved on into other things, and it did all of this. It did all of that. And I just could have been a better trader if I was technically trading this stuff. I didn't need to per se. That's why I've told people recently, learn the seasonality go, so you know what other people are looking at behind their, so you learn it, and other people are looking at. This is your bread and butter, these charts. Because big money, professional traders, the producers, the suppliers, all the big guys have to buy and sell in here. We're riding their coattail, and this is what happens time and time again. You could call it head and shoulder and all that stuff. I'm not a technical ninja on that part. Head and shoulder maneuver, come back down, whatever. And now we're back down at these lows. Which aren't the historical lows, but it's quite relatively low going back several years, isn't it? It gets boring. It gets boring. When it gets boring, it's because it's making money. I've cost myself money trying to change my ways because I'm sitting at home during this COVID deal and trying to intraday trade and stuff with my friends that intraday trade. And I've gone through stress again and nerve wrecks. And it's like, what? Why? When this is this easy? And it could make you great money. And you can go in here and, okay, just, you don't need one contract. You can buy more than one. What do we do here? Let's go to Maine. Let's go to corn. By now you have this all set up and saved. And let's go to a, look at volume. 25,000 traded already today. Let's go to a May, July contract. Look at that volume. Look at that 13,000 lot sitting there trying to go along. So let's go ahead and just place a market buy order. I'm gonna get two because it's saying here I'm short. And let's go long. There we go. We should be net one position long, and now we're going up. It's 12.50 a tick. I'm down 25 because I went market on 2. I had to close my short and open a long. And so it's really the calculations on this stuff could be a little bit off, guys, on the simulator, but because it's minus 12.50 on one, plus 12.50, it should be 0. It's counting it a little bit differently, but regardless, I don't really care about that. That's nickel dime issues, and I know that how this stuff works, and it calculates when it's live. This is a simulation, for the fact that we're getting software that's normally $500, $700 brokerage tools for free and free data. I can't nitpick these little skews that the simulator has. They're giving me the opportunity to practice amazing trading styles that bankers do, and I can't nitpick. I know what floor traders didn't count their money until like the end of the day, I think, on index cards. I mean, you should know and just keep a general know-how where you are with your position, so here we go, and so I just put on a long trade here on the simulator because the markets are open. It's Monday morning, 11 a.m. my time, Central. And, just going to let it run. It's an open position. Let it do its thing. Look, you see that big order there sitting at the 5s. We don't know if he's going to pull. You see an 11 here. We'll see all these other, but it's heavy, nice market to trade. That's why I filtered the heavy ones. Thick ones, thick liquidity. Okay. We'll see if this guy's going to pull here, if he's just testing around and there'll be a breakout down here, but I don't know. They play in the big world too, the big time frames. But I want you to remember, and I was going to mention this earlier, on the 4 hour, if you took this trade, even like on my alert, like if you're just following my trade, right? And this happened and we went up and you're like, man, Pete's amazing. And this happened. And you start saying Pete sucks. Look, this is a 4 hour chart. Don't forget that on the daily chart, it is trying to break out of that 100 EMA, and it's made a nice downward trend price action wise. On that note, it's bounced off resistance here, hit support. You would have probably, if you were following that more, had a bias to support resistance, because the levels you would have got out. When it broke down here, you could have went short. When it finally gapped down and broke down here, made a new resistance plus one bouncing off the EMA with the buyer failing candle over here. Not much of a very screaming divergence, but it was sliding down, pointing down. So it's not the best that I like to see. But you had enough confluence to say, let me take this one down. And, went from the 2s down to 170s, 30-cent move. How you place that spread is going to determine what that piece of that regular outright you're going to make. Pulls back, coming down here. Now we're hitting these double bottom support areas on daily, and it's trying to break out. And this is what this rally was last week. It broke out and, tried to get out of there, this moving average, and sellers came back in. It looks like sellers are taking some control here again last few days. And so, but seeing what it did in this time frame makes a whole lot of sense now, doesn't it? Sellers are still trying to hold. We don't know what's going on there. Big money's doing things for a certain reason. They could be churning over here before they finally all break out and go long. Because, again, what's our theory of this? Nat gas is cheap. Okay? So this is technical analysis, guys, 101. And then you just come in and put on your trade. Any questions, you guys know you can ask me personally. I just want to get most of this on video. Okay, because then, the responsibility is on most of you guys. I'm giving you as much as possible here in this segment to really have you guys off and flying on your own. All that support group stuff and all that stuff and the extra bonus stuff I throw, that's just extra stuff. I had somebody expect something way beyond from me recently, and I just do it anyway, guys. I help, but I know that a lot of you guys are have it in you to do this on your own and figure it out, because I'm giving you a lot. Gold, this should be out of here. We ain't trading gold. I put it here to show somebody the volumes, but I guess he had a point that in the later months there's something. If it doesn't have over several thousand contract in there, I'm not trading a gold spread. So let's go ahead and remove that and save it. I keep forgetting to save my workspace. So you should have like these 6 deals to start with. Just like here, these 6. High volume spreads. Okay. I hope this helps. You gotta just throw your little groove into this. What works for you. Okay. Now I'm thinking, this is just thinking out on a recording about intraday strategy I might try, but I don't know. So maybe look at a 15 and try to catch daily moves and just put on a spread trade and close your position out. For the guys that like to close a position perhaps at night in avoidance of gap up and downs the next day. But then again, you're just gonna spend more commissions. So we'll get about. I was just brainstorming that out loud on a video. We'll look at more intraday possibilities. Again, these are more fit for, I think, robots, and we can program a robot to do things like using Bollinger extensions here. And these would be buy-sell zones of extreme Bollinger areas. When we did this live, and we're pulling some money off the markets, but we were doing like 23 trades. Now see here, could have sold, just going by signals. Buy. I'm working on some automated things. Anyway, I'm just brainstorming this out loud here on this video. If you guys want that Bollinger indicator, let me know. That's about as easy as it gets, guys. Let me leave you with this again. Anytime I've tried to overcomplicate this stuff and get real technical and real pretty with it, I've lost money. And the former CME director of training, Pete Malmet, he didn't tell me directly, which I'm trying to reach him right now, but he said in multiple videos, don't overcomplicate this stuff and try to figure it all out. I know there's a lot of, super engineer types out there, guys, that are going to really try to figure this all out. Oh, Peter's not talking about flies. He's not talking about swaps. He's not talking about, packs. And I'm not going to talk about advanced stuff that's not necessary for anybody right now, and not even for me. Those are banker strategies, and these strategies alone right here are way more dominant than most outright traders out there that know anything. I've talked to guys that have been trading 20 plus years. They don't know what this stuff is. And they don't know. Oh, this is it. And so I hope you guys really get a lot of out this. Version V2 Forte Trader has been the best that it's ever could have been. And the first one was good, I think, but definitely blind compared to this version. Anyways, so I'll talk to you guys in the next video.